Okay, so today we're doing a deep dive into the VIX, the SIBO Volatility Index. The one everyone calls the market's fear index.
That's right. And we've looked at a bunch of sources covering how it works, the whole ecosystem around it, and maybe the most important part, the huge difference between the index itself and the things people actually trade.
Right, because our goal here is really to shortcut understanding this, well, pretty complex area and highlight that key distinction.
Exactly. The absolute crucial thing to get up front is this. The VIX index number you see, it's just a statistic. You can't trade it directly.
Like, the temperature? You can measure it, but you can't buy degrees?
Pretty much. The VIX is like a forecast for market turbulence, specifically for the next 30 days. It's calculated from S&P 500 option prices.
So it's the market guessing what's coming.
Yes, it's a real-time price for portfolio insurance, essentially. Model-free, just based on those option prices.
Okay, so it's implied volatility of what the market thinks will happen, not realized volatility, which is what actually already occurred.
Precisely. It's forward-looking.
Yeah.
And that expectation, that market anxiety, it usually moves opposite to the S&P 500.
Yeah, that inverse relationship is pretty well known. Market tanks, VIX spikes. So what kind of levels tell you, how scared the market actually is?
Well, you can sort of quantify that fear. If the VIX is down below, say, 15, that's generally seen as, well, complacency. Not much demand for that insurance.
Okay, column Cs.
Right. But if it pushes up above 30, that's high fear territory. Often coincides with some pretty sharp market corrections.
And then you get those really extreme spikes sometimes.
Yeah, if you see it shoot past 40 or even 50, that's crisis level. Panic. Usually means investors are really throwing in the towel.
Yeah.
It's rare, but it happens.
Okay, that makes sense for the index itself. But you said you can't trade it directly, so that brings us to the trading part, the dilemma.
People use things like VIX futures, VIX options, and these exchange-traded products, ETPs, you might know names like VXX.
Right, those are the popular ones people use to bet on volatility or hedge.
Exactly. But here's the critical point from the research. Trading these things, especially the ETPs, comes with a really significant structural issue.
A flaw, almost.
You could call it that. The big problem is these ETPs, like VXX, they don't actually track the VIX index number we were just talking about. They track VIX futures contracts.
Okay, futures, not the spot index. And why is that such a big deal?
Because it all comes down to the term structure. That's just the relationship between the prices of futures contracts expiring soon versus those expiring later. This is probably the single most vital concept here.
Okay, term structure. So what's the normal state for that?
The normal state, maybe 80 to 90% of the time, is called contango. Think of an upward sloping curve. Futures contracts expiring further out in time are more expensive than the ones expiring soon.
Later costs more. Okay, seems logical.
It does. But here's the catch for those long volatility ETPs. Because they track futures and futures expire, the fund has to constantly sell the front month contract, which is cheaper in contango.
And buy the next month's contract, which is more expensive.
Exactly. They have to roll their exposure forward. And that constant selling low, buying high, it creates this steady drag on the ETP's value.
Wait, hang on. So the products people buy often for protection are actually designed structurally to lose value most of the time.
That's the reality of contango. It's called the negative roll yield, or contango bleed. It's a systematic decay built into the product when the market is in contango.
Wow. Okay, so that explains why those things seem to grind lower over the long haul.
Absolutely. It makes things like VXX emphatically short-term tactical tools, maybe for a quick hedge or a bet on a spike. They are absolutely not buy-and-hold investments because of this decay.
So really, you shouldn't be looking just at the VIX level, but maybe more importantly at the slope of that futures curve, whether it's contango or what's the opposite?
The opposite is backwardation. That's when the curve inverts, near-term futures become more expensive than longer-dated ones. Downward sloping curve.
And that happens during market stress?
Typically, yes. When immediate fear spikes, the demand for near-term protection pushes those front-month futures prices way up. Backwardation is actually the only time these long VIX ETPs get a structural tailwind.
So contango favors shorting volatility, basically collecting that decay, while backwardation is the time when being long volatility actually has the structure working for you, not against you.
You've got it. Understanding the term structure is key. Contango means time decay is working against longs. Backwardation means it might be working for them, at least temporarily.
So navigating the VIX isn't just about how high the fear gauge reads today.
No, it's also critically about what the market is pricing in for the duration of that fear, which is reflected in that futures curve.
Right. So maybe a final thought then building on that. If the VIX index measures fear right now,
Then the VIX futures curve measures how long the market expects that fear to stick around. So maybe, for a disciplined trader, knowing if you're in contango or backwardation is actually more important day to day than the specific VIX number itself.
interesting angle. Definitely something to think about.